If the upcoming listing of World International Bhd has gotten you all hot and bothered, you'll have to wait a little longer. Earlier, EWI was aiming to have its listing by July, but now due to a delay in approvals for its strategic partner, the more likely timeline is either September or October. President and CEO Datuk Teo Leong Seng said that because of the entry of a big property group as co-anchor, it would take a few months for the Securities Commission to go over all the documents submitted. When asked exactly who the partner was, Chairman Tan Sri Liew Kee Sen would only coquettishly reveal that it was an international player from Malaysia and is a Singaporean entity. When asked whether Brexit had the group worried about its listing, Teo said the shock would only be momentary to financial markets. Teo says that Brexit would actually serve as an advantage as real estate prices in the UK are expected to drop due to the sterling tanking. Teo adds that as long as EWI keeps its costs under control, it should be okay. As the world spins on its new axis post-Brexit, global investment bank Nomura has cut its GDP forecast for Malaysia from 4.3% to 3.9%. Nomura Singapore Limited's Vice President Mikso Das said the adjustment was due to Malaysia's trade exposure to the UK, with most expecting a 2% correction to Great Britain's economy for the year. It needs to be pointed out that Nomura's forecast is lower than the official forecast of 4% to 4.5% for 2016. However, Nomura does giveth even as it taketh away and had recently upgraded Malaysia to overweight due to Brexit. According to Das, with Brexit, it reduces the prospects for developed markets as well as a drop in prospects for policy tightening. He says that Nomura is expecting all central banks to cut rates further and foresees a massive policy easing coming through. Finally, he notes that political risk in Malaysia remains high and it will take a while to regain investors' confidence. RHB Bank Bhd turned a new page in its history today as it assumed the listing status of RHB Capital Bhd. In the morning, the stock fell to a low of RM4.56 as Brexit fears continued to poison markets. However, by the end of the day, the stock closed up 3.2% to RM4.84. RHB's MD, Datuk Khairul Saleh Ramli, said that the listing marked the completion of its restructuring, focused on creating efficiencies and synergies within the group. Khairul Saleh said that it had resulted in significant savings for the group, a possible 180 million in cost per year. RHB is also planning to use Singapore as a launchpad to grow its business beyond Malaysia. The MD says that RHB's intention for Singapore is not just to do business, but also as a centre for the bank to do business in other parts of the region as well. Break out the champagne for Top Glove Corp Bhd. The world's largest glove manufacturer made its debut on the main board of the Singapore Stock Exchange as it aims to boost its investor reach and diversify its investor base. Chairman Tan Sri Lim Wee Chai said that the listing on the SGX will give the company a new leg up when it comes to image quality and branding. The listing will allow all existing ordinary Top Glove shares currently listed on Bursa Malaysia to be listed and quoted on the main board of the SGX, allowing shareholders to transfer their holdings from one market to another. To create liquidity and trading, Lim and his associates will sell approximately 20 million Singapore dollars worth of shares on the open market in the SGX over the next 12 months. It was a case of good news, bad news for ONG giant Sapura Kencana Petroleum Bhd. Good news is that SapKen's various units have managed to secure new contract wins and extensions worth a collective $125 million. SapKen says that the contracts are expected to contribute positively towards the earnings of the group for its FY17 financial year and for the subsequent financial periods corresponding with the contract durations. Bad news, SapKen saw its first quarter net profit fall by 58% due to lower demand for its rigs as oil majors cut back on their upstream spending. Net profit fell to 110.31 million compared to 260.69 million previously, while revenue also fell to 1.94 billion compared to 2.26 billion last year. SapKen continues to gird its loins as it anticipates the current challenging environment to persist, but says that it will continue to concentrate on order book growth and replenishment in key markets.